Meta is being priced like a system, like the toll road of the internet. And frankly, that's how investors get wrecked. They pay system multiples for a business that can still be rerouted. Today, we're running one test, which is my structure scorecard. This gives us Meta's structure-implied multiple and share price, providing us with a clear direction: buy, wait, or pass on Meta. This is educational, not financial advice. Do your own research. I'm personally using my own repeatable framework and Meta's own disclosed numbers to keep this grounded. So, here's the roadmap. To take us through the results of my Two Economies Framework, this episode has 4 sections. First, what do I mean by the two economies? Second is Meta's structure score and the rails that can break. We then convert that score into a fair multiple and price range. And finally, the decision rule I use, and the one dashboard that tells me when the thesis is broken. If you already know my Two Economies Framework, then please skip to the next section. My Two Economies Framework is really simple. We have the surface economy and the systems economy. The businesses that operate on the surface economy compete for attention, are reroutable, and price sensitive, while the businesses that operate in the system economy don't need your attention. They sit on a flow, take a toll, and compound because you can't easily go around them. Meta is not like Visa, but it's also not a random app. It's a hybrid, and that hybrid is where valuation mistakes happen. You see, Meta monetizes attention and targeting. Its family of apps is the engine. Reality Labs, well, that's the expensive science project. In 2024, revenue was $165 billion, with apps generating 99% of that, and the Reality Labs only 1%. The apps had an operating margin of 54%, while Reality Labs lost $17.7 billion. So the question is not, is Meta profitable? The question is, how system-like is that profit stream, and what multiple does that deserve? To answer this, first we determine a structure score. We score 14 requirements out of 0 to 2 each. Meta scores 18 out of 28. That's hybrid-leaning system. Here are the strongest system features. Operating leverage. The core business scales insanely well. Economies of scale. The infrastructure and ad optimization at Meta scale is hard to match. And network effects. Billions of users plus advertisers follow attention. Now the weak points, the rails that can break Meta. Firstly, while the flow is huge, right? All that human attention these apps generate daily, that flow, that attention is not unavoidable. Ad budgets can move. Secondly, Meta is downstream of standards it doesn't control. Meta has to use the iOS and Android tracking and data privacy rules. And thirdly, trust and regulation are not a moat here. They're a massive tax on Meta. So, good business, but defeatable rails exposing investors to risk. Here's the crux of the analysis. The market is currently valuing Meta as if it were more system-like than the evidence suggests. Now, I need you to hold that thought because we're about to translate our own structure score into a multiple. For the multiple, we're using the enterprise value to free cash flow. First, we anchor the multiple between the two economies like this. If you're pure surface, you get a 10 to 18 times multiple. If you're pure system type, you get 38 to 60 times multiple. Meta's score is 18 out of 28, which maps to a base range of roughly 22 times to 42 times EV to free cash flow. Then we apply evidence-based modifiers capped at plus or minus 20%. We get a net modifier of minus 10% because of those 3 key weaknesses we discussed earlier. The apps are meaningfully bypassable via competition, platform rules, and regulation. This gives us a final implied range of 20 to 38 EV to free cash flow. Using the trailing 12 months free cash flow from Meta's disclosures, we used $42.6 billion. That gives us an implied share price range of about $335 on the low end to $643 on the high end. Now here's the key. This framework says Meta is not a screaming bargain at any price. It's a buy only when you're being paid for the defeatable rails that we've identified. As of January 21st, 2026, Meta is around $604. That's near the top end of the structure-implied range. Not outside it, but tight. So the default stance here, despite the share price falling and making it look attractive, shout out to anchoring bias, is not to back up the truck. To make a decision, we need some rules, which I'll go over in the next minute. So, if it's not a screaming buy yet, what are investors really paying for? Well, the framework actually gives us a very clean look at this. The market is currently overweighting 4 things. Number 1, we have AI monetization optionality, paying now for a toll that isn't proven yet. Number 2 is winner take most belief, which is that the meta attention graph stays dominant. Number 3 is margin durability, that meta apps stay high margin even as AI capex ramps up. And 4 is capital returns. Investors continue to get buybacks and dividends as a valuation floor. These 4 factors are what I mean when I say the market is pricing in system-like structures into Meta's share price without the evidence to actually back it up. Okay, to make it obvious that Meta isn't a pure system business, let me give you 4 counterexamples. These risks could crystallize and Meta would immediately stop behaving like a system and start behaving more like a surface business, jeopardizing the current multiple. Okay, so first, on the regulatory side, if regulators force separation of key apps or restrict data combination, this weakens network effects and auction power. That makes Meta a pass if the remedies meaningfully break up the app bundle. Meta is also dependent on platforms and standards it doesn't control. If measurement signals degrade, ad performance will drop and the price per ad will flatten. This means that the return on invested capital will immediately compress. And one of the biggest factors for me is attention. Human attention is fickle. For example, if we look at my video that you're watching right now, the majority of the people who clicked on the thumbnail, they've already left. At most, 3 out of 10 of you have actually stayed to watch this far. Keeping attention is not easy. It's not an easy business model. So if user time shifts structurally away from Meta to a new format or platform, attention becomes avoidable, and ad demand follows attention. Lastly, Meta is ramping capex spend big time. If capital intensity rises faster than monetization, the compounding engine degrades. So the question becomes, does AI spend create a toll or just higher fixed costs? It's not known yet. Okay, so let's make a decision. Here's the repeatable rule. Gate 1, structure score. Meta is a hybrid-leaning system, 18 out of 28. So it deserves a good multiple, but not a perfect multiple. Gate 2, price versus range. I only get aggressive when price is closer to the bottom half of the implied range, because that's where you're paid for defeatable rails, for the risks that we've discussed in this episode. Near the top end, I'm just not that excited. At best, I'm selective. Gate 3 is the thesis health. If the thesis breaks, I don't argue, I reduce risk. For Meta, monitoring the thesis involves tracking key metrics such as ad impressions growth for volume, average price per ad growth for pricing power, family of apps daily active users or DAP trend for the attention flow, capex guidance plus actuals for capital intensity creep, free cash flow and free cash flow margin, right, to evidence that the toll is actually real, and regulatory milestones to ensure that the structural remedies risk is being watched. If price is currently high, and even just 2 of these elements deteriorate, then that's when system pricing becomes dangerous, because multiples compress fast. Okay, so here's the verdict. Meta is priced modestly above its structural midpoint and near the top end of the implied range. That doesn't mean to go out and short it. It means we only buy when we're paid for the risk, and we stay only while the thesis remains positive. Now, if you want to be the kind of investor who doesn't need a story to make a decision, just a system and a process to follow, subscribe. That's what this channel is.